Part 1, Crypto Research Report 2020. Modeling Bitcoin's Price with Irving Fisher's Equation of Exchange and Absolute Valuation of Bitcoin & Co. Is Tether a black swan for Bitcoin? Coin Corner. Privacy Coins and Mimble Coin. We would like to express our profound gratitude to our premium partners for supporting the Crypto Research Report. Disclaimer. This publication is for information purposes only and represents neither investment advice nor an investment analysis or an invitation to buy or sell financial instruments. Specifically, the document does not serve as a substitute for individual investment or other advice. The statements contained in this publication are based on the knowledge as of the time of preparation and are subject to change at any time without further notice. The authors have exercised the greatest possible care in the selection of the information sources employed. However, they do not accept any responsibility, and neither does Crypto Research Report, for the correctness, completeness, or timeliness of the information, respectively the information sources made available, as well as any liabilities or damages, irrespective of their nature, that may result therefrom, including consequential or indirect damages, loss of prospective profits or the accuracy of prepared forecasts. Editorial. Dear reader, for the first time in Bitcoin's young life, the global economy plunged into recession. In the wake of COVID-19, 40 million Americans were left unemployed, 15%. In Austria, there are 571,477 unemployed, 12%. In Germany, 2.639 million, 5.8%. Despite having an entire quarter's GDP erased from 2020, hedge fund managers are all singing the slogan, all-time high by the 4th of July. What this slogan means is that the S&P 500 is expected to hit a new all-time high by July. Although this sounds unbelievable, central banks around the world have the power to make this happen, and so far, they seem to be doing everything they can do to weaken their currencies and artificially prop up asset prices. If we take America for example, the S&P 500 and Dow Jones dropped double-digit percentages during March. In response, the Federal Reserve created $3 trillion out of thin air, and financial markets bounced back. The stimulus that the Federal Reserve took 2 months to inject is larger than the entire stimulus that they injected in response to the 2008 Great Recession. The Federal Reserve acted so quickly and so swiftly, because they know how fragile the financial system is, and how dependent markets are on cheap money. 6 months ago, hard money advocates laughed at U.S. Representative Alexandria Ocasio-Cortez for championing modern monetary theory, MMT, and now, the Fed has promised to do unlimited quantitative easing until we recover. To be clear, there is really no difference between MMT and quantitative easing. The only difference is that with the former we drop the pretenses and stop pretending that we will pay back the debt one day. Despite unprecedented quantitative easing, trillions of short-term credits to the repurchase agreement market, and lowering interest rates to zero, the U.S. dollar index, DXY, barely moved. This means that the dollar can take a lot more abuse from the printing machines before it starts to devalue against other fiat currencies. Also, the 5-year forward inflation expectation for the U.S. dollar is sitting at a low 1.43%. This means that despite massive debasement of the U.S. dollar, markets expect inflation to be below the Federal Reserve's target 2%. Traditional markets are no longer reflecting the state of the economy. Instead, they are reflecting the central bank's effort to keep the pension system alive and to get Trump re-elected. Unfortunately, there is no turning back now. Every hiccup in the economy needs to be met with even greater inflation, leading to an even wider gap between reality and finance. Let's not forget that every time the central bank creates new unbacked units of currency, this comes at the expense of everyone that currently holds the currency. Unfortunately, this expense isn't evenly distributed. Single-handedly, the largest cause of wealth inequality in the West is inflation. Google Cantillon effect. And where was Bitcoin during all of this? From $3,600 in March to $10,000 in May and then back down again to $9,000, the ride on the Bitcoin roller coaster has made some nauseous and some rich. Many cryptocurrency companies are in dire shape due to the shutdown and lack of customers, but Bitcoin hodlers just keep holding on in hopes of a post-halving bull market. So far, the halving has been a non-event. Bitcoiners around the world joined in on Zoom webinars to celebrate Bitcoin's special day, but the Bitcoin price hardly budged. The uncertainty surrounding the economy has definitely put a damper on the crypto market. However, there is still hope yet. As governments around the world wage currency wars to protect their export markets and inflate away their burdensome debt, some households may turn to Plan B. We hope that you enjoy this special edition of the Crypto Research Report, marking its 10th publication. In the last edition, we covered Plan B's stock-to-flow model. In this edition, we present another popular model that is used to forecast Bitcoin's future price called the equation of exchange model. We discuss how Ethereum's Vitalik Buterin and Multicoin Capital's Kyle Samani approached this model, and we discuss a devastating critique of it by Basic Attention Token's Scott Laughlin. In this special edition, we also feature a guest article by Schlossberg and Cuz Pascal Hugley on the topic of Tether. Hugley investigates whether Tether is really being used to manipulate the price of Bitcoin or not. Since the beginning of this year, $5 billion worth of Tether USDT have been issued. If the new Tether isn't fully backed, and if Tether eventually collapses, this will most likely bring down at least one exchange and wreak havoc on the price of Bitcoin. Finally, this edition of the CRR features an exclusive interview with the development team of Mimble Coin, which is a new privacy-based coin that was airdropped to Bitcoin holders for free in December. Since December, the price has soared 6,000%, and the authors argue that their token economics are superior to the privacy coin Grin, that they are more scalable than Monero, and that they can prove their total supply unlike Zcash. Also, we are happy to announce that the Crypto Research Report has struck a strategic partnership with Cointelegraph, the largest crypto news company in the world. The September edition of the Crypto Research Report will be distributed by Cointelegraph on their website, which gets 10 million views a month. The goal of the joint effort is to publish the results of a landmark study on institutional demand for crypto assets in the German-speaking countries. This study is being conducted by Professor Dr. Philipp Sondner from the Frankfurt School of Finance and Management, Professor Dr. Alfred Taudes from the Vienna University of Economics and Business, WU, and the editor of the Crypto Research Report, Demelza Hayes. To make sure you are the first to receive this free quarterly report, subscribe on our website. Last but not least, we especially want to thank our premium partners of the Crypto Research Report. Coinfinity in Graz is a broker in Austria that is famous for creating an easy-to-use Bitcoin cold wallet called the Card Wallet. Coinfinity also enabled Bitcoin purchases at 4,000 retail outlets across Austria via the Bitcoin Bond program. In addition to Coinfinity, we are exuberant that Bitpanda has joined as a premium partner of the Crypto Research Report. Bitpanda is a fully licensed exchange based in Austria. They have recently added Bitpanda Pro, which offers more liquidity and lower fees. We are personally excited about Bitpanda Metals, which allows investors to diversify their portfolio with physically backed and 100% insured precious metals. In addition to Coinfinity and Bitpanda, we have a new sponsor, Mimble Coin. They are a new privacy-based coin that has been on the market for 6 months. Demelza Kelso Hayes and the CRR team an absolute valuation approach to crypto assets. It has happened globally with such speed that even a market veteran like myself was left speechless. We are witnessing the great monetary inflation, an unprecedented expansion of every form of money unlike anything the developed world has ever seen. Paul Tudor Jones, CEO Tudor Investment Corp. Key takeaways: in-chain velocity for most coins is decreasing, while off-chain velocity is increasing. This provides evidence that growth in speculative transactions on exchanges is faster than the growth in using cryptocurrencies to buy goods and services. Approximately 40+ million cryptocurrency users exist globally according to our research. Surprisingly, the number of cryptocurrency users in a country is positively correlated with that country's GDP per capita. High GDP means more cryptocurrency adoption. The target addressable market for crypto assets is approximately $212 trillion. The largest use cases include medium of exchange including all global fiat currencies worth $126 trillion and consumer loans with a global value of $42 trillion. If Bitcoin penetrated 10% of this market over the next 10 years, each Bitcoin would be worth $397,000 in 2030. Bitcoin's off-chain velocity is at an all-time high. Fiat currency with high velocity is normally a bad sign, but does that rule apply to crypto? One of the most common ways to estimate the price of a cryptocurrency is with the equation of exchange. This model comes from the 20th-century economist Irving Fisher. One of the main insights of this model is that the more often a currency changes hands, the less value the currency has. Money changes hands more frequently when people believe the money will lose value. For example, if there is high inflation, people will hold on to the money for the shortest amount of time possible before tossing the hot potato to someone else. For the past few years, Bitcoin's off-chain velocity has been increasing. But what does this mean? Vitalik Buterin famously applied this model to crypto assets in 2017 in order to argue that coins need velocity sinks that encourage hoarding. Partner of Multicoin Capital, Kyle Samani, wrote an article in agreement with Vitalik's understanding of velocity. He wrote, "As I noted in Understanding Token Velocity, the V in the equation of exchange is a huge problem for basically all proprietary payment currencies. Proprietary payment currencies are, generally speaking, susceptible to the velocity problem, which will exert perpetual downwards price pressure. Due to this effect, I expect to see utility tokens that are just proprietary payment currencies exceed a velocity of 100. Velocities of 1000 are even possible." However, Scott Laughlin, an engineer for Brave Attention Token, explains in a recent PAPR that both Buterin and Samani are wrong. This article models Bitcoin's price with the equation of exchange model and discusses why the relationship may not be as straightforward as Buterin and Samani surmised. Introduction to the equation of model. Each distributed ledger network offers a specific range of abilities to their cryptocurrency users. The fundamental value of a coin can be defined as the aggregate summation of each individual user's valuation of the network. The short-term prices of cryptocurrencies are determined by supply and demand and may not reflect their fundamental values. However, price can be a noisy signal of a cryptocurrency's fundamental value over the long term. Long-term refers to multiple periods of macroeconomic cycles including expansions and recessions, which the cryptocurrency market has still not completed. Several papers have used the equation of exchange model to estimate Bitcoin's price in 5 years, 10 years, and even on longer time horizons. For example, Kraken and The Economist estimate Bitcoin's price to be $1.91 million by 20,221, Satis estimate $96,000 by 20,232, and Vision and $65,000 by 2028.3. The main reason each report has different prices is that estimating future demand for Bitcoin and other coins is based on assumptions. The equation of exchange model is an absolute approach to valuing crypto assets. This means that the model gives a target price that crypto assets should be priced at based on assumptions regarding changes in supply and demand. The equation of exchange model relies on the theory that the value of each cryptocurrency should be directly correlated with the dollar volume of the economy it supports. A cryptoasset economy that has $1,000 in trading volume each year and has 10 coins in circulation will have a fair coin value of $100 if each coin is traded once during that year. The value of each cryptoasset is inversely related to its supply, i.e., the number of coins that are in circulation, and its velocity, i.e., the number of times each coin is traded per year. The growth in GDP of each coin or the cryptoasset economy will be determined by product market fit. The likelihood of future market adoption is what drives speculative today. The absolute valuation approach is inspired by Mill's equation of exchange, later formulated by Irving Fisher. Point 4. In this model, the percentage of the total addressable market (TAM) can be used to estimate a cryptoasset's implied future price. The traditional equation, MV equals PQ, was first applied to Bitcoin by Chris Bernanke in his original 2016 report for Coinbase. Point 5. The equation of exchange, MV equals PQ, describes the balance between money in the economy and demand for that money for purchases of goods and services. To estimate the size of the economy supported by cryptoassets, the following steps are taken. The economic size of all relevant use cases for a crypto asset are summed. This is referred to as the target addressable market, TAM. This involves 3 assumptions. Which use cases are applicable for cryptocurrencies? What is the total market capitalization in US dollars of each use case? PQ. What is the growth in the total market capitalization in US dollars of each use case over the next decade? An estimate of the percentage of each target addressable market that is penetrated by cryptoassets over a 10-year horizon is calculated. This involves two assumptions. How much of each use case will be penetrated by cryptocurrencies? What is the growth rate of penetration for cryptocurrencies over the next decade? This involves an assumption, to estimate the growth rate of penetration for cryptocurrencies over the next decade. An assumed adoption rate of cryptocurrencies can follow an S-curve, a linear curve, an exponential curve, a mean reversion curve, a log curve. This paper assumes an S-curve for all cryptocurrencies. Each annual addressable market is divided by each coin's velocity to determine the coin's market capitalization. This involves three assumptions. What is the supply M of each cryptocurrency over the next decade? Some cryptocurrencies follow supply schedules, such as Bitcoin that follows a Poisson distribution. Other coins have supplies that depend on a voting mechanism, such as EOS. Therefore, the former will have a lower forecast error than the latter. In this analysis, the supply of each cryptocurrency is assumed to be the average size of the crypto asset base through the year, which is necessary due to the inflationary nature of most cryptoasset protocols, including Bitcoin. What is the velocity, V, for each cryptocurrency? What is the growth in velocity for each cryptocurrency over time? To determine the price per coin, the total addressable market multiplied by the penetration rate is divided by its circulating supply. Once the price per coin is forecasted for each year over the next decade, the discount rate must be applied in order to calculate the net present value of the price of each coin for each year. This involves the following assumption. The discount rate should reflect each coin's risk and the nominal inflation rate. This report assumes a standard discount rate of 30% for each coin. Assumptions in-depth monetary supply. The M in MB equals PQ is measured by the supply in circulation of a crypto asset. M is the monetary base necessary to support an economy. The supply of some cryptocurrencies is easy to estimate if their supply follows predetermined processes, Bitcoin and Poisson, etc. Supply is coming from two main areas: new coins released into circulation either through mining, staking, or reserve sales, and coins being sold on the market from wallets. The goal of M is to estimate the amount of coins that are in each year's circulation and will be available on the market, often referred to as the float. The float is comprised of two parts, flow and stock. The flow is the amount of the cryptoasset that will be issued each year, and the stock is how much has already been issued. This report assumes a stable supply of each cryptoasset for each year and forecasts the supply over the decade based on each cryptoasset's programmed supply schedule in its protocol. However, a more in-depth analysis would try to forecast future circulating supply by calculating the float or circulating supply of each cryptocurrency. To calculate the float, hodled assets or assets that are hoarded must be subtracted. For example, if 100 million coins are issued and 60% are hoarded in wallets that never move, M is equal to 40 million coins. This applied to Coinbase users who purchased Bitcoin in 2016. 57% of Coinbase users held their Bitcoin in 2016 as a store of value and speculative asset instead of using it as a medium of exchange. 6. Velocity, V, is the velocity of each unit of money in the monetary base. If Alice passes a Bitcoin to Bob once a year, that's an annual velocity of 1. If Bob passes on that same Bitcoin to Eve, that's an annual velocity of 2. The value of a coin is inversely proportional to the total discounted supply and inversely proportional to velocity. Thus, a currency which increases its velocity will lose value with respect to any other currency whose velocity doesn't increase that much. Velocity is a key variable where many reports diverge. Vision and S estimate of velocity was 10. To put this into perspective, the US M1 money supply has a velocity of approximately 5. What pulls down velocity is friction. Since cryptoassets are natively digital, their friction will be lower than physical cash, which will place an upward pressure on velocity compared to physical currencies. On the other hand, physical fiat currencies have high inflation rates, which promote high velocity. Cryptocurrencies with low inflation rates and purchasing power appreciation will have a downward pressure on velocity. Velocity example: if the total amount of economic transactions paid for with Bitcoin in 1 year is $100 billion, and each Bitcoin changes hands 10 times on average over the course of the year, then the collective value of the coins is $10 billion, and if there are 18 million Bitcoin in circulation, then this would mean the utility price of each Bitcoin is roughly $555. If they circulate 100 times, then the collective coins are worth $1 billion, which makes $55 per Bitcoin.